So in this section of the course, we're going to be talking about the fundamental aspects of candlesticks. What they are, why they're important. We're going to talk about how they're constructed, the open, close, high-low range, basic elements of a chart, symbols, colors, and how we can use the basic aspects of candlesticks to guide our trading. So to get started, we're going to talk about what candlesticks are and why they matter. Candlesticks are a really unique way of displaying financial information, and pretty much anything that is traded, be it stocks, options, cryptocurrencies, commodities, even orange juice futures, can be traded and interpreted using candlestick charts. They show us an incredible wealth of information, and they show us price and price action that occurs within specific periods of time, and we use this information to guide our trading by understanding that candlesticks and candlestick patterns are representative of the underlying market psychology. They're an indicator for the mind of the market and what the market is thinking, doing, and thinking about doing in the future. That is how we use candlesticks to interpret and decide to act. So what are candlesticks? Like I said, a wealth of information. Each component of a candlestick gives you some insight into what's happening in the market. The shape, color, movement, and proximity can all tell you individual pieces of information that you can collectively use to guide your trading decisions. So why is shape important? The shape of a candlestick tells you what's happening within a specific period of time. A small red candlestick means a very different thing than a long red candlestick. The color of a candlestick is important. Red tells you that the price is falling, where green tells you that the price is increasing. The movement of a particular candlestick is also indicative of what's happening. If you have a very small candlestick, that means that the price has been contained for a period of time. But if you see a very, very long green or long red candlestick, it shows violent movement and a lot of price action. And it's very different than what's happening in the preceding candlesticks. And proximity of candlesticks is also important. If you see multiple candlesticks that are very small, very, very close together, that tells you that there is a small range of trading and that we could be in an equilibrium pattern or something else is happening behind the market to contain that price. If you see a lot of white space, a gap between candlesticks, that tells you that something has happened to motivate the market to move significantly in one direction or another. And it tells you to go and look and investigate in your charts to try and understand why and the how for that market movement. So all of these elements, shape, color, movement, proximity, all work in harmony together, and it's our job as technical analysts to understand why they're moving the way they're moving, what each individual movement, shape, color, or proximity means in conjunction with each other, and use that window into market psychology to guide some trading decisions. That's really what this is all about. Before we can get into the nuts and bolts of how we actually create a candlestick, we need to understand the difference between a candlestick chart and a more traditional price line or graph that most people will be more familiar with. So to visualize this, what I have here is a price line chart from Camel, a website that compares historical prices to current prices on Amazon.com. So by looking at this chart, we can see and track the prices of a basketball over several months. On November 9th, the price of a basketball was hovering around $78. So we can see that in February it went up to 95-ish. Quickly fell down to 60 and has been riding on relatively low inventory for a little bit before hitting $106.32. So aside from the price, this doesn't tell us a lot more information. We can see what the price was, what the price is now, but it doesn't guide us on the why and how prices have been moving. Single figure charts and graphs lack context, and they don't give us any information that we can use for trading other than what is the price now, what was it the other day. We need more, and candlesticks give us that more. So to expand on that example, what I have here is a line chart for Google, aka Alphabet, a very popularly traded stock. And in this example, we can see that the range of our prices has been hovering in between $12.70 and about $1200. We can see that prices have been falling, been recovering, but we don't see anything that really explains the price action. All we can see is what's happened and what the current price is. This is where candlesticks come in. Here's the same Google chart represented by candlesticks. And in this case, we can see so much more information about what's happening on a day-to-day or period-to-period level on the stock. This is very likely a daily chart, and we can see that we've got tightening ranges. We have supports being broken. We see consolidation before continuation. We see patterns forming and breaking. We see more consolidation. We see increased volatility, patterns. We see earnings reports where prices jump, huge volatility. We see tightening ranges again, decisions being made. We see the market dumping the price down. And we see a bullish response in this candlestick that guides us and gives us information leading into the next candlestick. All this information is conveyed to us through candlestick charts. And through courses like the one you're taking now, you can learn to interpret and understand more of what's happening behind the chart simply by understanding what each candlestick means, what each pattern means, why breaking this level is key for the next few days, and why this pattern in particular led to 4 days of downside price action. All of this information can be learned through the understanding of candlestick analysis. So now we have a little bit of an idea of what we can do with candlesticks and why they're important. But before we can move on to actually utilizing candlesticks, we need to understand the basic foundations. Chart basics, how candlesticks are constructed and what each of the colors, shapes, and movement can mean. And we need to understand time correlations and candlesticks and how individual charts can correspond to charts on larger time frames. Charts are comprised of two primary elements. One is going to be the time, the second is going to be the price. Price changes based on whatever's being traded. So if you have a penny stock, the range will be, let's say, 10 cents to 25 cents. But in the case of Alphabet, we're looking at $1,000 to $1,300. Price changes based on whatever's being traded and whatever you're viewing on the chart at that time. If you zoom out far enough on Google, you'll see the price down in the hundreds. Time ranges from 1 minute intervals to monthly intervals, and you change that based on whatever time frame you want to look at. In this case, we can see that we have a 1 day interval where each of these candlesticks represents one full trading day of action. Now that's going to be important because we can have multiple hourly candlesticks that will fit inside this candlestick, and you can zoom in and investigate exactly what's happening on this day and see a chart represented very similarly to the one we have here. Now, to understand candlesticks, we need to understand what each of them means. The color of a candlestick is very important. Green or white candlesticks indicate that prices have went up during the trading period, whereas red and black indicate that prices have moved down. Now, this is important because the position of the open and close changes based on the color of your candlestick. Green candlesticks are strong if you're hoping the price is going to go up. Red candlesticks are strong if you're hoping the price will go down. Now we need to understand the basic construction of each candlestick, and we're going to start with the green candlestick. There are 4 primary components to any candle: the opening and closing price, and the highest and lowest points of range within that period. On our example, we can see that the opening price is the bottom of this rectangular aspect of our candlestick, whereas the closing price is the top of the rectangular aspect. The lowest price, or the lowest part of the range, is going to be the bottom of the wick, and the highest is going to be at the highest point of the wick. So our body of our candlestick represents the opening and closing prices, and the wicks represent the extreme ranges of price action that occurred during that day. To make more sense of it, let's look at it in the form of a line chart. We can see that our opening price started right here. We dipped down at some point in the day, setting the extreme range of our low price. The price drove up, setting the high, before ultimately coming down again and closing right around the top of our green candlestick. This is a little bit different when we're dealing with red candlesticks. Again, we have 4 primary components: the opening price, the closing price, and the highest and low points of the range. With a red candlestick, we know the price has gone down, so our opening price is at the topmost part of the body of our candlestick. The closing price is going to be at the bottom. The high and low points of our range are the same, where our highest price is at the top of the wick, and our lowest price is at the bottom of this wick. Again, represented with a line chart, we can see our opening price being pushed up, faltering before coming back up a little bit, setting our closing price here. So this is how a particular candlestick can show you the same information that you would get on a line chart on a much smaller scale. And this particular candlestick, let's say it represents 5 minutes of trading action. This entire 5-minute span of all this information of price points that occurred on this line graph are contained within this candlestick. There's so much useful information here. So let's talk about candles and price over time. So one candlestick on this chart represents one period of time, and that can be 1 minute or it can be 1 hour. In either case, this red candlestick that my cursor is on now represents either 5 minutes or 1 hour, just like this is 1 hour, 2 hours, 3 hours, 4 hours, 5 hours, 6 hours, and so on. What's very important to understand is that if we're looking at 5-minute candles, 1, 2, 3 5-minute candles equals 1 15-minute candle. So movement shows all price action within the period. Now when we combine our charts and time frames, the movement that happens across all three of these candlesticks can be combined into a single 15-minute candlesticks. What this means is that all of the action that is contained in smaller candlesticks gets nested into a larger time period candlestick. If we have 4 15-minute candles, these 4 15-minute candles together make up 1 hour, so they will be represented as one candlestick on an hourly chart. So let's look at that in a little bit more detail. Here we have the same chart on 5, 15, and 60-minute intervals. This is the same stock, same time periods, and what we're looking for is to see how these smaller time frames fit into the larger time frame. So on our 5-minute chart, we can see that we've got a green candlestick. We closed, opened it a little lower, and we experienced quite a bit of loss over the next 10 minutes. So 1, 2, 3 5-minute candlesticks. Total of 15 minutes. Now we take all of this information that's contained within these 5-minute candlesticks and we put it into this one 15-minute candlestick. It has the same high and the same low as the total of these candlesticks because it is these candlesticks. And likewise, the next 3 candlesticks in the 5-minute chart represent this block of time, and so on and so on. Going to the 60-minute chart, 1, 2, 3, 4 15 minutes equals 1 hour, and we can see that the entirety of these 4 candlesticks is contained within the 60-minute chart. And that's what it means when I'm saying smaller time frames are nested into larger time frames. Anytime we're looking at a 60-minute chart, we can drill down to the 15 minutes to see what happened within this candlestick to get a better understanding of the context. What happened in this large candlestick to make it form the way it did? What happened in this 15-minute candlestick that allowed us to build up such a large upper wick? We want to know what the price action was on a smaller time frame so we can get a context of our 15-minute time frame. So if we're looking at 60, we might want to zoom into 15 and we want to zoom in on 5 to get more information. Why? Because each individual candlestick tells us so much about what's happening in the market. It gives us insight into psychology. It gives us insight into what the market is thinking, doing, reacting. And we use that information collectively to guide our decisions on larger and larger time frames and ultimately our trades. So we've done the introduction to candlesticks, and you should understand the basic layout of the chart. You should understand the 4 main components of a basic candlestick construction: the high, the low, the open and close, how different time frames are visually represented, and most importantly, how larger time frames integrate smaller time frames into the construction of their own candlesticks. By drilling down, we get more information, and with more information, we can make better decisions. And that's why we're here, to make good trading decisions based on technical analysis of candlesticks.